Hello friends and welcome to StudyIQ. I am Joycey Joy and today in this lecture we will discuss about the RBI Circular on lending rates. So let us first look at what is the current affair. Now if we analyze the current affair, recently RBI, that is the Reserve Bank of India, had issued a circular to all the scheduled commercial banks. So the circular mentioned about the lending rates by the scheduled commercial banks. That is, the lending rates means the rate of interest that is charged by the scheduled commercial banks on the loans provided by the commercial banks. So, in the recent circular issued by RBI to the scheduled commercial banks, it has asked the scheduled commercial banks to link the lending rates to external benchmark. So, this is the current affair, and based on this, we will see what is the rationale of RBI and how this circular is significant. Let us first look at the rationale of RBI. Now, RBI, we know it is a central bank of Indian economy and it is also the monetary authority of Indian economy. So, when RBI makes any policies, it will be aimed at enhancing the economic growth by the way of making regulations in the financial sector or in the banking sector. So, let us see what is the rationale of RBI. First of all, RBI wants to give this benefits of repo rate or change in repo rate to the customers. Now, we need to understand a concept in order to understand this point. So, let us first look at what is meant by monetary policy. Now, monetary policy is a policy that is adopted by the central bank of an economy in order to increase or decrease the money supply. We can say in order to regulate the money supply in an economy, when the central bank, that is in case of India, RBI, when RBI adopts a policy, it is called a monetary policy. And in India, monetary policy is undertaken by MPC, that is Monetary Policy Committee. And this is headed by the governor of the RBI itself. So, MPC is the authority that is responsible for making or formulating monetary policies in Indian economy. So, this monetary policy is aimed at increasing or decreasing the money supply, that is regulating the money supply. So, in order to increase and decrease the money supply, the Monetary Policy Committee will increase or decrease the benchmark interest rates. And in India, the benchmark interest rate is the repo rate. So, repo rate is considered as the benchmark interest rate, and by increasing the repo rate, it will adopt a tightening monetary policy. That is, when the benchmark interest rates increases, that means money supply will decrease, and when repo rate decreases, the money supply will increase. Let us see what is the logic here. Now, the logic is that repo rate is the rate of interest charged by RBI from commercial banks. So, RBI will give loans to commercial banks for a short period of time, and the interest charged on such type of loans is called repo rate. So, when the repo rate is high, it means that the cost of borrowing for the commercial bank is high. Now, when the repo rate is less, it means that the cost of borrowing for the commercial bank is low. So, whenever the repo rate is low, commercial banks can borrow more from RBI, thereby pump more liquidity into the market. So, this is the logic. Now, what is meant by transferring the benefits of change in repo rate? So, whenever the repo rate is less, it means the commercial banks or the scheduled commercial banks has lesser cost for raising funds from RBI. So, they should definitely bring down the interest rate they charge for the loans. So, this is called transferring the benefits of change in repo rate. Now, we have seen that in the consecutive last 4 monetary policy reviews, the RBI has intentionally brought down the repo rate in order to increase the money supply in the economy. Now, if the customers or if the market has to benefit out of this repo rate reduction, then what should happen? The scheduled commercial banks should be able to transfer this benefit to the customers, and this can be done only by reducing the interest rates of the loans charged by commercial banks from the customers. So, in order to transfer the benefits of a change in repo rate, especially a reduction in the repo rate, RBI has provided this circular to the scheduled commercial banks in order to link their lending rates with external benchmark. So, this is the first rationale. Now, let us see what was the practice that was followed by the commercial banks? It was in the year 2015 that the base rate was replaced by MCLR or marginal cost of lending rate. The base rate was replaced by marginal cost of lending rate. Now let us see what is the marginal cost of lending rate. So marginal cost of lending rate, it is an internal benchmark. Why it is an internal benchmark? Because the rate or the interest rate is fixed on the basis of internal factors. For example, fixed deposit rates, the source of funds, the savings rates. These are all some internal benchmarks. So based on these internal benchmarks, the rate of interest charged on loans are decided. So this is why MCLR. So MCLR was introduced in the year 2015, and the then RBI Governor Raghuram Rajan decided that the system used by banks in order to price their loans should be changed. Therefore, base rate was changed by MCLR. So this was the system that was followed. Now, in the year 2017, an internal study group of the RBI recommended the adoption of external benchmarks in order to ensure an effective policy transmission. Now, what is meant by an external benchmark? Now, according to an external benchmark, RBI has given certain options to the banks in order to decide their interest rates. First one is the repo rate. So, the repo rate, as we said, it is the interest charged by RBI from the commercial banks on short-term borrowings. So repo rate is one external benchmark that can be used by the commercial banks. Second one is T-bill or treasury bills. Now third one is any other benchmark market interest rate produced by Financial Benchmarks India Private Limited. Now what is meant by T-bill or treasury bill? So treasury bills are government bonds or government debt securities, and the maturity period is less than 1 year. And the T-bill rates are determined by the central bank. That is, RBI decides the T-bill rates, and this is used as a primary instrument for regulating money supply and also for raising funds. So RBI itself decides the rate of interest on treasury bills. So treasury bills or repo rates act as certain external benchmark, and based on the external benchmark, the commercial banks or scheduled commercial banks can decide their interest rate. Now, in 2017, this recommendation was given by an RBI's internal committee. Now, why did this recommendation came up? Why external benchmark was used instead of internal benchmark? The reason is that when the scheduled commercial banks were using internal benchmarks, they were not able to pass on the benefits of a monetary policy change to the customers. This was the reason why RBI shifted from internal benchmark to external benchmark. Now, if we take an example, the Reserve Bank of India had made a total reduction of 75 BPS or basis points between February and June 2019. But the scheduled commercial banks on an average had decreased only 29 basis points on the interest charged by them on loans. So from this, it is clear that an effective or adequate interest rate transmission has not taken place. So the benefits of a repo rate reduction or a reduction in the benchmark interest rates is not passed on to the customers. So this is the reason why RBI has recommended to link the interest charged by commercial banks with the external benchmark, and this has been issued by RBI. This instruction has been issued by RBI in the recent circular. Now let us see what is the order of RBI. The first one, the scheduled commercial banks, that is the lenders, have to link all the floating rate loans with that of external benchmarks, and this will be effective from October 1st of 2019. Now, RBI has recommended that the banks are free to choose any benchmark. We have seen there are many external benchmarks. So, the banks can themselves choose from any of the external benchmarks. First option is repo rate, that is decided by the Monetary Policy Committee and which acts as a benchmark interest rate. So, first option is repo rate. Second one is treasury bill. And two categories, first one is 90 day and second one is 182 day, because treasury bills have a maturity period of less than 1 year. So these are the options given by RBI to the commercial banks. So they can choose which external benchmark they need to, but they must link their interest rate with that of external benchmarks on or before October 1st of 2019. Now, third instruction is regarding the spread of the commercial banks. Now, we need to understand what is meant by spread. Now, spread means the difference between the interest that the commercial banks give on their savings and the interest charged by the commercial banks on their loans. So, definitely the interest charged on loans would be higher than that of the savings interest rate. So the difference between both these is called the spread of a commercial bank. So the banks have been given the freedom and autonomy to determine their spread over the benchmark rate. So benchmark will be provided by RBI, and from the given options bank can choose, and the spread can be determined by the bank itself. And in the order, RBI has also made it mandatory to have a credit assessment of the borrower. So these are the orders given by RBI to the scheduled commercial banks. Now let us see what will be the impact of this order given by RBI. First of all, this will help in the transmission of rates. That means if RBI makes any change in the repo rate, then this benefit can be transferred to the consumers or the customers. Now, we have seen that in case of treasury bills also, RBI or the central bank will decide the interest rate. So, if the external benchmark is based on the interest rate of treasury bills, again the benefit will be passed on to the customers. So, the first benefit is that there will be a transmission of rates from the scheduled commercial banks to the customers. Now, second one, this will lower the interest cost. This is because at present we have seen that the Monetary Policy Committee has adopted an expansionary monetary policy. That means the repo rates have been reduced consecutively for many times now. So, by reducing the repo rate, RBI wants to increase the money supply. So, definitely banks will have lesser cost of borrowing from RBI. Thereby, the interest that is charged from the consumers or the customers will also be less. So this will lower the interest cost. Third one, the impact is on the interest on deposits. We have already seen the concept of spread. Now, spread is the difference of interest charged by the commercial banks on loans with that of the interest that is given by the commercial banks on savings or deposits. Now, whenever the interest on loan comes down, the savings interest rate also comes down. So, this means that this will be a demotivation to the households in order to undertake savings. So, the savings rate in the economy can come down. Now, fourth impact is on the consumption and borrowing. So, with more money supply in the economy, the consumption will increase. Also, more money supply implies that there will be more investment in the economy, thereby more output, more employment, thereby more income and standard of living. So, this will definitely boost the consumption expenditure in the economy. At the same time, when the interest rate falls, as a result of this, the borrowing in the economy will also increase. So, this will lead to increased borrowing in the economy, thereby the investment and the liquidity will increase. So these are all some of the possible impact of a transmission of interest rates from scheduled commercial banks to the customers, and this is also the rationale of RBI to pass on the benefits of an interest rate cut to the customers from the scheduled commercial banks. You can find the PDF of this lecture on our website www.studyiq.com. You can also follow my Facebook page for more video updates. You can write to me at joycey.studyiq@gmail.com for any of your queries and clarification. Thank you.